Good afternoon or good morning, depending upon where you are. I'm in California. It's a beautiful day here. My name is Shane Handy. I am the founder of therationaltrader.com. We don't have a whole lot of time today, so just by way of introduction, I run a live trading room. I trade live with real money in front of people every day. So I have a very clear idea of what it means to be a trader and what it takes to learn how to trade. If you have seen some of my other presentations, you're probably used to very sort of abstract view of the challenges that you face as a trader. Today's discussion is much more technical. We're going to talk about order flow and what it is. We're going to clear up some of the mystery and how you can use it to improve your understanding of what's happening in the market. We cleared the audio tests, so we don't need that slide. Disclaimer, risk. Trading is risky. In fact, you can lose all of your money. In fact, the data shows that you're likely to lose it all. So understanding the why of that is very important. I encourage you to go to the site and watch the 3 Challenges webinar that talks about why trading is so risky and why it is so difficult to learn how to trade. Right? We don't have time for that discussion today. We're going to talk about what is order flow? All right, so there's some mystery around this if you're new, and even those of us that have been around a while, it took me a while to get my arms around it. And order flow is simply how the orders are flowing into the market. It's very aptly named. Is it aggressive buying? Is it aggressive selling? What's the speed of the buying or selling? What direction is it moving and how fast is it moving? What's the volume? How much buying or selling is going on? And now this used to be called tape reading, and this is exactly what they used to do. The trades would transact, and they'd come across the wire, and they'd read them right off the tape. And from that, they would divine, what the market was doing in some magical way that I can't figure out. With the advent of computers and the ability for us to see it in a more efficient way, you have something more like this. This is a time and sales window, and what you see is the trades would scroll across as they're being transacted in the market, and in fact, it's to build the charts that you're used to looking at. Okay. I know people in this window, look at these trades, scrolling across the screen, figure out what's going on in the market and find good entries. I tried and tried, and I think you need specialty or mojo to do it. I've never been able to figure it out. Fortunately, more recently, we have other ways that we can represent the order flow. Okay, and one of those ways is footprint. All right, and there's a lot of information here actually that really helps you understand what's going on in the market. And the key here is that when you're trading, you're in competition with every other trader out there. Your money friend. And so in order to understand what's going on in the market, what's the market dynamic, how many people are participating and what are they doing? And then based upon what are they doing, right? And from that you can infer what your opponent is thinking. Now you're in a position to compete with them. Now you're able decision to try to outthink your opponent. This is how you succeed in trading. You don't succeed because you can format the MACD in some way better than your competitor. Everyone knows how to do that. You succeed in trading by outthinking your opponent. So what we're going to talk about is this data to understand what's happening in the market. And a lot of information, there's a lot of problems with this chart. Okay. The first problem is that there's a lot of information coming at you. inputs per minute. And even if you're an experienced trader, it can be difficult to assess, well, exactly what am I looking at. If you're less experienced and you're still dealing with the natural, biological-based fear response that you have when you're about to put money at risk, or harder, because all of those inputs are not just inputs to your functions. They're inputs to your emotional machinery. And it's very easy to get yourself just tied up in knots or almost like a nut as you see all this information coming at you. And so the idea here is that we want to be able to use this information, okay? And so the learning curve to use just this chart, I think, is very steep. All right. Hang on, Sherman. Okay. The noise in this chart is very high. So the signal to noise ratio is not very good for you. We're going to spend most of our time today on the charts. I've got some presentation material here to show you the concept I'm looking for. And then we'll dive into the charts, and Sherman, I'll answer your question. Exactly what's on what you're looking at on a footprint chart. Okay, so the key here is that this information can help you tell a story about what's happening in the market, and you can better figure out what to do. All right, this is a very good way of thinking about it. Humans are very sort of narrative oriented. We like to understand what's happening and why. In fact, your financial media really caters to that need. They'll tell you, at the end of the day, there'll be somebody out there telling you, this is what happened and this is why it happened. It'll sound very plausible. It may have no connection to reality, but it'll sound really good. And that satisfies that need. Okay? Our politicians do the same thing. We tend to want very simple answers, yes or no, black and white answers to even very complex, difficult questions. And the market is a complex place, and the answers are not always simple. So if you're able to tell yourself the story of what's happening, it helps you make a better decision. All right. So I'm going to show you how I do that today. But first, the first thing we do is we have to understand, well, what is it that we want to see? All right. What is it that we want to see? And I lost my mouse. So the first thing is called absorption. So by way of example, we're looking at there's lots of buying in the market. Buy, 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 buy. The price is going up. Lots of aggressive buying. Okay. But then the price stops going up. You're seeing lots of buying, lots of aggressive buying. But the price stops going up and, in fact, starts to go down. Now, this may just be a pullback in the trend that's been established, or you may have found the high of the day. The point is that there's a lot of buying, but the price is not going up. And what that means is there are sellers stepping in, absorbing all of that buying. And I like to think of it like a sponge. Okay? Every trade has a buyer and a seller. So as the market climbed up, there was lots of aggressive buying, but there was a seller for every one of those trades. And you get to a point where you see lots and lots of buying, but the price is not going up. That means there's more sellers. There are sellers stepping in, absorbing all of that buying, right? And then there are aggressive sellers stepping in, driving the price down. So we want to find this absorption. We want to find cases where we see lots and lots of buying, but the price is not going up, or the inverse, lots and lots of selling, but the price is not going down. This is called absorption. Okay? The next thing that we want to look for is exhaustion. Exhaustion is sort of the opposite. Okay, you're seeing buying, 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 but then you sort of just run out of people that are buying aggressively. And I represent that on the slide here with this sort of decreasing font size. Sometimes it's like what you see here, where there's a gradual decrease in buyers, aggressive buying, strong buying. Other times it's very abrupt. you have lots of strong buying, and then suddenly, poof, they're all gone. And it's like a runner who's just run out of steam. I like to think of it as a sprinter that's running up a hill. And he gets to the top, he just can't go anymore. All right, and what happens is, if you run out of people who are willing to buy, then the market naturally falls. And again, sometimes it's just a pullback in a trend that's been established, or it's you found the high of the day. I'm going to show you examples of both today. The inverse is true as well. You're seeing lots of selling, or rather you're seeing a decrease in the amount of selling, and then price starts, you just run out of sellers. This is called exhaustion. So absorption, lots of buying, but price is not moving up, or exhaustion, you ran out of aggressive buyers, and so the price moves down. There's a third one, though. There's a third thing. This is, okay, I see lots of buying, buy, aggressive buying. But then what happens is I see lots of selling, a lot more selling than buying. The other side is stepping in and really pushing the market in the other direction. Okay? And again, it might be a pullback, it might be the high of the day. These are people that are, the other side is stepping in aggressively, and what you're seeing is a dramatic increase in the other side stepping in. In this case, this is the example of the top. You've got lots of buying, and then just a huge amount of selling come in, or the reverse for selling. You see lots and lots of selling, and then a dramatic increase in the amount of buying, and the price turns. Okay, this I call acceleration. So we're looking for three things: absorption, exhaustion, and acceleration. How do you define aggressive, or how do you detect it? Sudhir, I hope I pronounced that correctly. I'm going to show you. Okay. Yes, Richard, everything I'm describing is both up and down. The examples I'm showing are just tops, not bottoms. You also get these in combination, okay? So you'll have just really strong buying. You're seeing lots more buying than selling, really aggressive buying. But then you see lots of selling. So this by itself is a trade setup for me. If I see a lot of buying, way more than the selling, and then it suddenly just turns on a dime, and now I see lots of selling relative to the buying, that's a trade setup for me. I'll start looking for an entry. Okay, this is acceleration. Now, you also see these in combination, and my favorite is this one here, where you've gotten exhaustion. You saw lots of buying, you just ran out of buyers, right? You just ran out of steam, and then you see just big selling. And so you ran out of buyers, and then the other side stepped in and just took over and drove the market down. Exhaustion plus acceleration, one of my favorite signals, actually. All right. And also is true, all right, that sort of a decrease in the amount of sellers, either gradually or dramatically, a dramatic decrease. But then lots and lots of buyers stepping in, market the other way. Okay. Now, the question is that Sudhir, how do you define it and how do you see it? All right. And to understand that, we have to go back one step and talk about our trade acted in the market. Okay. So this is just a standard dome here. This is from a couple Fridays ago. This is the oil market. And I've drawn this, so let me snap that real quick. And what you're seeing is, this should be very familiar to most of you, is all the people that are saying, I'm willing to sell. So at 48.45, there's 35 contracts on offer. Ask. The term ask and offer are used interchangeably. At 48.44, 25 are on offer. These are passive orders that are sitting in the market. All right, they're sitting in the order book. All right. On the buy side, you've got the same thing. All right, 52 contracts on bid. Bid is the term we use for buying at 48.30. So these people are saying, look, I'll buy from you if you'll sell to me at 48.30. And these guys are saying, I'll sell to you if you're willing to pay 48.45. Right now, the key is what happens in the middle. All right, where the two meet is important. So the current offer is 48.36, and the current bid is 48.35. Being stated for each. Right. Now think about what this means. There are 4 contracts on offer at 48.36. Someone's saying, if you're willing to buy from me, I'll sell to you at 48.36. All right. Conversely, if you're willing to sell to me at 48.35, I'll buy it from you. These are passive orders. Now, what has to happen for that to occur? And this is probably the most important thing to take away from today's discussion. What has to happen for the next trade to occur? There is no way for 2 limit orders to execute against each other. There's no way for 2 passive orders to execute. For the price to go up, somebody somewhere has to say, I'm willing to pay for the market order. And that order will go off at the ask price. So at this point in time, the ask price is 48.36 and the bid price is 48.35. If the trade goes off at the ask, that means some buyer somewhere was willing to pay more, and that's aggressive buying. For the price to go down, someone somewhere in the world has to say, okay, I'll accept 48.35. I'll sell to you at 48.35. I'll accept less than these other people. And that's aggressive selling. If someone comes in and says, I want to buy 50 contracts, what will happen is 4 of them will get bought at 48.36, and then 21 more at 37, and 20 more at 38, and then some of them at 39. And you'll see the price just kind of flush up. Okay? So you can tell if it's buying or selling by what price the trade is transacted at. Does it trade at the ask or does it trade at the bid? Now the software tracks this. The software will tell you that the trade went off at the ask or the trade went off at the bid. Okay, I'm just looking at questions. I see I answered it already. All right, so this is how you define if it's buying or selling, or rather aggressive buying or selling, since every trade has a buyer and a seller. Is it aggressive buying or aggressive selling? Where did the trade go off? Did it go off at the ask? That's aggressive buying. Did it go off at the bid? That is aggressive selling. Okay, so now we can go and look at the footprint chart, and from that, make some decisions about what's going on in the market. Here is a screenshot. I'm going to switch to the live chart in just a minute. All right, but let's just talk about what we're seeing here. So one of the questions earlier was, what is this red and green line on the left? All right, that's if the bar closed up or down. This, you're looking at a 10-tick range bar chart. Okay, on the right side of every bar are the trades that went off at the ask. Okay, the trades that went off at the ask, right? Oh, I lost my cursor. Right here, the trades that went off at the ask. The buying, you think of it as the buying side. The numbers on the left are the trades that went off at the bid. That's the selling side. Okay, and so you can look at this chart and you can see, are the buyers aggressive or are the sellers aggressive at any given time? All right, and we're going to use this data to help us find cases of absorption, exhaustion, and acceleration. I don't know how you get a footprint chart in TOS, Peter. The platform I use is Sierra chart. You're going to see that in just a moment. This is a 10-tick range bar chart. It's nice because this is 10 ticks deep also, so it sort of, there's a nice symmetry there. I use 10 ticks because that just happens to work well in the oil market. All right, so if you look at this bar, 10 contracts were traded at the high of the bar. 10 contracts were bought aggressively. 49 were bought here. 4 were sold at the low of this bar. Down here, 26 were sold at 47.42. Only 2 were sold at 47.41. That should be a clue. All right. And so what happens is, as the market is trading, the current bar is these numbers are increasing on both sides as aggressive buyers buy and as aggressive sellers sell. Okay. And what we want to do is we want to take this information. I don't want to look at this chart. This chart's too noisy. There's too much input coming at me. And so what I want to do is figure out, okay, well, when am I seeing absorption? When am I seeing exhaustion? And then plot that on a different chart, like you see here. All right, so we're going to take the noise out. We don't want to look at this chart. It's too hard. It's too hard to see it, at least at first. Later on, you'll start looking at it because you understand better what's happening in the market. But right now, let's just find cases where I see exhaustion and absorption. And so the screenshot here is showing you, I'm not sure what date this was. This was January 9th in the oil market. The screenshot here is showing you the 3 things that I described for you. The yellow triangle is absorption. I'm going to show you exactly what that looks like on the footprint chart and how we determine that's absorption. All right. The blue diamonds are exhaustion. Okay. And then these in-bar triangles are acceleration. Okay. So this signal here I really, really like. Blue exhaustion. I ran out of buyers and I see a lot of sellers stepping in. You'll also notice that you then pull back. You then pull back here into exhaustion. I pull back and I just run out of buyers, it seems like. And then something really cool happens. You pull back again and you nick that level on absorption, meaning there was a lot of buying, a lot, but the bar closed down. Price is not going up. I shorted this right here. All right. Now, let's go look at a real chart. All right, so let's get rid of the screenshot. This is Monday. Yes, the yellow triangles show up on the chart in real time. It's not. It'll actually flicker on as it notices the condition, but it is not considered a valid signal until the bar closes. Okay. Well, the numbers are on a different chart, actually, Sherman. What I'm doing is I'm applying some logic to this, and from that, I plot it here. So I don't have to look at that chart, okay? I'm showing you Monday here, all right, because I wanted to show you current data. We can go back, actually, and look at that day on the 9th real quick. Let me see if I can find it. That's the 15th, the one I just showed you in the presentation. That's when I built the presentation. Okay, so let's just get oriented here. And all I'm showing you right now is absorption. Okay. This is when the oil market opens, CL open. Right, it's 6 o'clock in the morning Pacific time. I'm on the West Coast. And this line here is 6:30 when the stock market opens. And then this line here is 7 o'clock when there's often news. So those times in Eastern time would be 9 o'clock, 9:30, and then 10 o'clock. All right. The gray highlights you see are blackout periods. All right. So I have a very strict set of rules that you have to follow, right, to help you develop the discipline you need to be successful as a trader. And those rules state that you're not allowed to take a trade in the first 5 minutes of the open. All right. It's too risky. We don't like to take trades on 5 minutes on either side of the stock market open for the same reason. The oil market, other markets get very volatile when the ES opens, all right, or they can, and because of that, you have to be careful. And the same thing with news. If you've got news coming out, you can see here the news really affected the market. It drove it higher into what turned out to be a very nice entry short. So Richard's asking, are some of those yellow triangles potential false indications? Well, you have to define your terms here. If you're looking for the magic bullet that says, when I get a signal, I'm going to enter, then you're going to look for that for the rest of your life. That's the holy grail that doesn't exist. Okay. What we're trying to do here is understand what's happening in the market, and absorption and exhaustion are going to help us figure that out. Okay. So I'm going to tell you the story of what I see happening here, just using absorption. Okay. The market opens up, and actually, see where did we come in? We were so overnight. You know, London kind of drove the market down a bit, not too much, but it was mostly down. Okay. Here we open up, and you know that's a fairly decent signal actually. The purple line is yesterday's pit close. Okay, so there's a lot of eyes looking at that price level. All right, the orange line is where we opened. Okay, another very important level. And then this white line down here is the overnight low. Okay, and down here is yesterday's low and yesterday's high. All these are drawn automatically by the software. Okay, this is Sierra chart. All right, and what you see happen here actually is you know, it's not difficult to understand. The market right off the open drove up into yesterday's close. There was a lot of buying up there, and all of it was absorbed. So let's go look at that candle. All right, that's 1-9 at 6:02. All right, I actually prepared Monday, but let me go find it real quick. 1:15, 1:7. Let's go forward now. Okay, so right here, 1-9 at 6:02. When you look at the amount of buying that's going on right here, what you see is right at 6 o'clock, not a whole lot of trading going on. 1-9 at 6:02.14. I want to make sure I'm looking at the right bar gang. Yeah, okay. I actually think, I'm sorry, I think that I think we have to use this week because this is the H contract, and the H contract was not the front month on the 9th. All right, so we're going to have to switch to Monday. I'm sorry, my apologies. But let me finish telling you the story of what I see happening here, and then we'll dig into the footprint chart. So the market, it runs into yesterday's close. There's a lot of buying. All of it gets absorbed by sellers, and it drives down to the open. The people that drove it up defend the open. And you see that. There's selling, sellers step in and send it up. The sellers try to bring it down. The buyers bring it. There's a fight going on right here. You do not want to participate in this fight. You stay out of it. There's another way that we look at. There's another indicator we put on here to help us see that you're in the middle. We don't want to enter in the middle. We don't have the capital to survive the big boys fighting each other. All right. So ultimately, it breaks lower. Okay. And in fact, it falls into the overnight low, and that's where it finds support and drives back up to the open. And here you see the seller step in again. It's very, very common to see this. The market sells off, and then when you come back up, the sellers step in and defend the open. There's a lot of buying right here. It all gets absorbed. This by itself is a legitimate short signal. Okay. There's some exhaustion in here as well that you see in the on the screen. I'm not displaying it here because I wanted to talk about absorption first. But if I just show you that screenshot real quick, this one, you can see actually the you got acceleration. These green bars are acceleration into exhaustion, acceleration away. You're very interested now, and then on the pullback here, you get absorption here. This is CLG. Again, it looks a little different on the live chart because that's the H contract and the G contract was front month at the time. Okay, so let's switch back to Monday so we can look at real data and have the chart line up correctly. All right, so Monday was the 26th. And again, I'm just showing you absorption right now. 8 o'clock. Let's get a little bit earlier here. Right here. Okay, this is what I want to show. And then in the footprint chart, we're going to bring that up to the 26th. More. All right. So when we look at this, what do we see? Overnight, market was mostly up. When London opened, it pushed the market up. And we come into the day, we actually set what looks like a top right here. All right, that actually sets the overnight high. You pull back to absorption. You can't. There's a lot of buyers there, but they can't break the high anymore. Here, you kept breaking the high, so you stop breaking the high. I don't take trades before the oil market opens, but that looks like a turn to me. All right. Here at the open, you can see there was a lot of buying, but all of it got sold. All of it got absorbed. All of it got absorbed, and they drove the market down. There was a little fight right there, but they lost. All right. You get down to here, and it starts to get interesting. Here's the previous low of day. Sherman's asking, why do the sellers defend the high? Well, I think you mean why do they defend the open? If you're a bigger trader, all right, and you sold at 45.86, then if the market comes back up, you don't want to see the buyers take control. You want to try to keep that market under 45.86 and drive it down. So they step in and defend it. You'll see it actually on this day. I'll show you in just a moment. So here you get the market sells off. It goes through yesterday's point of control. It goes through yesterday's close. It gets down to the previous low of day, and here you see, I really like this. You set a level right there, but then you nick it on absorption. And what that means is there was a lot of selling there, but it all got absorbed by buyers, and then it happens again. Okay, they nick it again by 1 or 2 ticks here. A lot of selling, all of which got absorbed. Let's go look at the footprint chart for these two bars, 611 and 620. Okay, 611's right here. Look, the market's been falling. Look at all the contracts going off here. 119, 112, 103, 113, 130, 64, 20. A lot of selling's going on here, but the price is closing up. Remember, the left side is aggressive selling. The left side is people saying, I'll accept less. People stepping in and taking the bid. Here you have hundreds and hundreds and hundreds of contracts being sold, but the bar closes up. And to the earlier question, this green line on the left is showing you where the price opened and the fact that it closed up. The next bar opened here, it also closed up. The next bar opened here, it closed down. That's what that red and green lines mean. This bar here matches this one here. Okay, this one right there. Okay, so you're interested already because you're seeing lots and lots of selling. I mean, look at previously. There really wasn't that much selling. People have got, what's happening here is people have gotten excited about the market breaking lows. All right, now I want you to ask yourself, who's selling down here? Let me show you what happened. The market goes up here, up to there. Who's selling down here? Do you think it's a professional trader selling at the lows? It's not. They won't be a professional for very long if they're selling the lows. By definition, a pro is buying the lows and selling the highs. Okay. There may be some gaming going on here, trying to drive the market lower. But for the most part, the pros sold up here, and they're buying down here. And in fact, you can tell that happened because the market turned. All right. So let me look at questions. Okay, so Billy is saying none of that's tradable. That's a good point, except that you don't know that at this time. That looks like a pretty decent signal. In fact, that looks like a great signal, and I went long right there. Okay. So why does that tell how you see that? You'll be a little bit more specific, Sherman. So if you nick the low here on lots of selling, but you can't go lower, that's a long signal. All right. I went long right, actually right there at 36. Now, what happens here is pretty interesting. You get into this nasty fight, which you don't like, right? To Billy's point, you much prefer it when you just bounce out of there and then the battle occurs. In this case, it was pretty ugly. I was in right here long. You can see this on the daily video that's on the site. I recorded this live. All the trades are recorded live. You get into this nasty fight, and something very interesting happens right there. Okay, that absorption signal is of great concern to me since I'm long. I don't want to see lots of buying that's all getting absorbed. And at this point, that's 18 ticks off of my entry, and my first target is 20. And so we had a long discussion in the room about should you take an action there. And the answer is that you're allowed to if you have solid information that says the market can't go higher, and you do right there. Okay, so some of my members either took one off or they moved their stop to their entry. Okay, now I just let it go. All right, in this case, you actually get another break of the low on absorption, and it's actually even a better signal at this point. And then the market hits my target, my first target, and then it goes up, and again, another case. You're up at yesterday's point of control. Yesterday's point of control means the price level at which most of the trading occurred, okay? And you're running into trouble. There's lots of buying, but the sellers are pushing it down. So it would be reasonable to take something off if you can. I let it go, and then on that signal, I added right there. Set my next target to just in front of the open, and you'll see why. I got filled right there, okay? And you can see the seller stepped in and defended that level because they drove it down pretty hard, okay? Well, what's ironic here is that this here is actually where you want to get long again, but that's you're just getting stopped out because your stop is right here now. Your stop is right there. It's below this level. But the market continues higher. Now, there's actually another short that sets up here, but I'm running out of time. And I actually shorted this up here and then caught this really nice down move, okay? Because it's the same thing. The market just took off. This is panic in the market, all right? And you're breaking that level, all right? You're failing to break it on absorption. There's a lot of buying and you can't break it. So all of these are legitimate entries here when these bars close down. I believe there's exhaustion up there. Let's see real quick. I'm running out of time, so I'm going to have to refer you to a tutorial I'm about to invite you to. Give me just a second here. Yeah, so you see down here, why you like this long so much is, look, the diamond is exhaustion. You fall into yesterday's low on absorption, and then when you test that level, you run out of sellers. An awesome, awesome long right there. Okay, and in fact, for those of you that are pullback oriented, there's another entry right there. On this pullback, you see lots of selling, but they can't drive it lower. When you look at the footprints for these bars, you'll see what I mean. Let me find it real quick, and then Reed, I understand I'm running late here, so hold on. I need to find the exact time here. I want to look at that one, 8:10. And then when I'm done here, this is a topic that you can't really do justice in 45 minutes. So I'm going to invite you to a tutorial that discusses this in a lot more detail. All right, it's free. It's this Saturday. Here's that case. Look what you see. Tell me what you see. The market is selling, 131, 107, 46. But the bar closes up, and then when you test that level, 3 are sold at the low. Hundreds to 3. I just ran out of people that were willing to sell. This is a long signal when you want to get long. Okay, and the market climbs up from here. All right. There is a, let's see here. Let me go to this slide, and then I'm going to send you a link to a tutorial. If this has piqued your interest, then there is a tutorial that you can come to. But before I do that, I want to end with this visual. I love this image. When you look at that cat, and you look in his eyes, you can see he is the apex predator and he knows it. And that's who you want to be. You don't want to be the prey. You don't want to be the person, whoops, that's the wrong button. You don't want to be the person that is, I can't get it to do what I want. There we go. You don't want to be the person selling down here. You want to be the person buying. In the same way that you don't want to be the person selling down here. Okay, and you can't do that. If you're selling the lows, you're gonna lose in the long run. If you're buying the highs, you're gonna lose. You have to understand what the market participants are doing. This is screaming at you to get long. All right, so is this up here? Exhaustion, and then I nick that level and can't go up anymore. Absorption, absorption. It's a great short. I did very well on Monday. All right. Let's go back one slide. That's not appropriate to what we're doing here. This Saturday there is a tutorial. It's free. If you like, if this piqued your interest, we're going to go over this in very in-depth detail, nauseating detail. Actually, it's 3 or 4 hours long. Just depends on the questions. 8 o'clock Pacific, 11 o'clock Eastern. All right. There's no cost. Just I'm a trader. I like to trade and I like to teach. My service is very inexpensive. We can talk about all that later. There's no hidden costs. It's $95 a month. That's it. All the custom studies you see are free. You don't have to pay for those. Let me send you the link. Or Reed may have already done it. If not, let me put it into the chat here. Let's see. Did you do it, Reed?
It is out there. Yes, I did send it out.
Okay, so what we'll do then is, hang on, George, I'll answer that question. What we'll do is take what we described here and actually go into a lot more detail on the logic behind the signals that get created, okay, and how I use it every day. I use this every day. All right, so it's actually the trading program tutorial that I give to my members. It's somewhat accelerated because 3 or 4 hours is really not enough time. You need screen time. Questions? George, this will work for anything that has bid-ask volume. Okay, anything that has bid-ask volume, where you can tell aggressive buying from aggressive selling. Does your system work on TradeStation? Pierre, not yet, and maybe not at all. I can't figure out yet if TradeStation can do it. All right, so those studies are written for Sierra Chart. Okay, other questions, and I believe I'm out of time. It looks like that's it. So is this you on platform? I don't quite understand that, Sherman. Looks like no more questions. So again, if you're interested, sign up for the tutorial. Last time I did this, I had 160 signups. A lot of people, 80 people showed up. We had a good discussion. The webinar will be recorded, so you don't have to worry if you can't attend. You'll get a link later in the day. It's a lot of time too, so if you're not able to spend the entire time, then I usually break it up into a couple of parts, so it's easier to pick up where you left off. Reed, I am waiting for you to step in and take over. I think I'm out of time.
Yeah, I'll take it back from you. I did put the link in there for them to follow, and so if you're ready to hand it back to me, I can take it away.
Yeah, let me just try and answer Sherman's question. The chart that I use every day is closer to this. Okay, there's a lot more information on here that helps you understand when you're thrashing sideways. I use this every day to trade. I use this today to trade. All right. Today we had this nice fall here. It's actually signaled very nicely right there. when you fail to, you can't re-break the high on exhaustion, and then you get this really nice fall. Unfortunately, there's never a pullback in there for you to get in if you miss that entry up there. And then down here, I tried to get long down here. I didn't get in. I was a little too conservative with my entry. I bid for right there. And you can see the market went up nicely from there. We got into a long, ugly thrash, but that's okay. You just sit on your hands, and that's a beautiful run. Had I done the normal entry of 67, that's a 98 tick run. The target's 100. That's funny. Previous close would have been a reasonable target, 52 instead. Okay, so this is what I do every day. I use this method of reading the market, helping me understand what the other market participants are doing, and from that, based upon what price is doing, infer what they're thinking. You can see another beautiful short right there, right back to the open. Sellers are stepping in. Buyers are trying to push it up. The sellers are absorbing it all. There's a beautiful signal right there. Very unusual activity lately in the oil market. You don't normally get moves like this after noon Eastern. It's been a pretty volatile market lately. Okay, I think that's it. Reed, thank you very much for having me. Everyone else, thank you for attending. I appreciate your time.